What if the secret to building real wealth wasn't about having a genius-level IQ or trying to predict the future? What if it was all about mastering your own mind? Well, today we're going to crack open Benjamin Graham's masterpiece, The Intelligent Investor, a book that Warren Buffett himself called, quote, the best book on investing ever written. So, how are we going to do this? First, we're going to uncover the investor's single greatest enemy. And trust me, it's probably not what you think. Then we'll get super clear on the line between investing and just plain speculating. After that, we'll get practical and look at a blueprint for building a resilient portfolio. And finally, we'll tackle how to tame the market's wild mood swings by, you guessed it, mastering our own. All right, first up, the investor's true enemy. We're going to kick things off by challenging this whole idea that you have to be some kind of math whiz to be a great investor. According to Graham, intelligence in investing has almost nothing to do with your IQ. It's really about your emotional strength. It's having the discipline to stick with your plan when everybody else is either running for the hills or popping champagne corks. It's really about character, not about complicated calculations. And get this. This quote comes from one of the most brilliant minds in all of human history, Sir Isaac Newton. And he said it right after he lost an absolute fortune in the stock market. His story is just the perfect example of what Graham is talking about. So here's what happened. Newton got in early on a hot stock, he doubled his money, and he got out. Smart move, right? But then he made a classic mistake. He kept watching. As he saw his friends getting richer and richer, that fear of missing out, that FOMO, it just became too much. He jumped back in at the very peak of the bubble and lost everything. It's the ultimate proof that your temperament, not your intellect, is what stands between you and financial disaster. Newton's story, that emotional failure, it leads us right to Graham's most fundamental question. Are you actually an investor? Or are you just gambling with your money and calling it investing? The difference is actually really simple, but it's profound. See, an investor is buying a piece of a real business. They're thinking like an owner, focused on long-term value. A speculator, on the other hand, they're just betting on which way a number on a screen is going to go. It's really the difference between building lasting wealth and just rolling the dice at a casino. Graham gives us a super simple test for this. A true investor does these three things. They do their homework on a company, they make protecting their money their number one priority, and they aim for good, solid returns, not lottery ticket jackpots. If you're not doing these things, you've crossed over into speculation, plain and simple. And if you want a perfect example of how crazy pure speculation can be, check this out. Back in 1998, traders got the ticker symbol for a tiny company, TMCO, confused with Ticketmaster, TMCS. They just blindly hit buy, and the wrong stock tripled in minutes. They weren't investing in a business. They were literally betting on a typo. Okay, so we've identified our own emotions as the enemy, and we've committed to being investors, not speculators. So what's next? Well, now for the practical part. How do we actually build a portfolio that reflects this intelligent way of thinking? Right off the bat, Graham just tosses out that popular rule of thumb you've probably heard, the 100 minus your age rule for stocks. He argues it's not about how old you are, it's about how financially secure your life is. So for example, think about an 85-year-old who has a great pension and a big nest egg. That old rule would say she should be almost entirely in bonds. But Graham would say, hey, her financial stability means she can easily afford to keep a big chunk, maybe even 75%, in stocks for better long-term growth. Now, let's flip that. What about a 25-year-old who's saving up for a down payment on a house? They need to protect that money. So even though they're young, a more conservative split, like 25% stocks and 75% bonds, might be the more intelligent choice for them. It's all about your life, not your birth date. So where do you find companies to invest in? Well, the famous investor Peter Lynch had this great piece of advice: use what you know. And that's a fantastic starting point. But Graham would add a really important warning. Familiarity is just the beginning of your research. It's not the end of it. And here is a perfect example of making that exact mistake. The story goes that Barbra Streisand invested in Starbucks for one reason: she loved their coffee. Look, just because you're a loyal customer doesn't automatically make a company a good investment. Being a fan is not the same thing as doing your financial homework. This brings us to our final and maybe the most important skill of all: how to stay sane and rational when the market itself is acting like a moody, totally unpredictable teenager. Let's take a look at a classic case from the dot-com bubble, a company called Inc. to Me. Now, their sales were climbing, and that got everyone really excited. But what investors chose to ignore because they were blinded by all the hype was the much, much bigger bar right next to it, the company's massive and growing losses. They had never actually turned a profit.
And here's where the market's mood just completely broke from reality. Investors got caught up in the euphoria and drove the stock up an insane 1,900%. Then, when the mood swung to fear, the stock collapsed, all the way down to 25 cents. And the crazy part is, the business was actually making more money by then, but the market's emotions were all that mattered.
So the huge lesson here is this. A great company can be a terrible investment if you buy it at a ridiculous price. The intelligent investor waits. They wait for a giant, a company like Johnson & Johnson, to face some kind of temporary problem. When the fearful crowd is selling, that's your chance to buy a world-class business on sale. Look, you can't control which way the market is going to go, but you have absolute 100% control over the things that really determine your success. Your costs, your expectations, your tax strategy, and most importantly of all, your own behavior. That's the real battlefield where investing is won or lost. And that's really the ultimate lesson from the intelligent investor. The market is going to have its crazy highs and its panic lows. That is a guarantee. Your financial success doesn't depend on trying to predict those swings. It depends on whether you can keep yourself from swinging along with them. Your long-term wealth depends not on the market's actions, but on your reactions.